So, ladies and gentlemen, welcome to this session. This purely is for the 6 p.m. class. Yeah, 6 p.m. class, 6 p.m. to 8 p.m. Yeah, and this is advanced financial management. So when you hear advanced financial management being mentioned anywhere, what comes to your mind? An easy paper. What have they told you outside there about advanced financial management? What have they told you outside there about? They must have cheated you that the paper is what here is very tough. Yes, I can see somebody saying ni ngumu sana. Yeah. This is the very easiest paper. You can't compare this paper to papers like management accounting or even to financial management papers at this intermediate level. Here we have very, very few topics, and most of these topics, because they are few, we know that they shall be tested like all of them. So it's very easy to predict this particular paper. For those students who are with me last semester, like for MA, FM, I mean, we were able to predict like 100% of the papers. What you're required to do from the word go is to become very serious in terms of being an active student. We don't want passive students who will never give us even answers in classroom. Yeah, they're only copying notes. AFM doesn't want that. So if today, for example, you are to be employed as a finance manager of Safaricom, what will be your day-to-day activities in these big firms? Finance manager, every day you go to the workplace, what do you think in this case here will be the day-to-day activities? What are the duties of a finance manager? Planning for financial resources of the company. I love that. That we have to do a financial plan. That is number one. Number two, the online students, I expect you to type something there. I expect you to type something there. We're not writing. Just say something. Those financial resources, yeah, because at the end of the day, ladies and gentlemen, you'll be required here. Remember, you are a manager just like any other manager. Remember, these managers, basically, they do 5 activities. They do 5 functions. In this case here, they plan, they organize. So organizing, you must be very good in communications here. Yeah, then we have what we call coordination. Yeah, and then we have controlling, yes. Key functions of any manager. But you see now, as a finance manager, there are those duties that we know will always sit in our desks, which can never be done by anybody. These ones here can be done by any manager, right? Like number one, we shall be involved in what we call investment appraisals. Investment appraisals or investment decisions. So if it is Safaricom, for example, that wants to go to Ethiopia, new market, then amongst the professionals who will be able to talk to the board, to the shareholders, will be a finance manager who will be able to come and look at what cash flows do we expect in the future from this project. So we expect cash flows, for example, year 1, 50 billion, year 2, 60 billion, year 3, 45 billion. So once in this case, your finance manager has these futuristic cash flows, what will they do? They discount them. Once you discount them, you get what we call present value. Then you subtract what we call initial outlay. We get, in this case here, net present value. If the net present value is positive, the project is very bad. If positive, the project is good. So we recommend the project to the organization here. So those are the kind of things we shall be doing. We're looking at investments. We shall be appraising investments. Once we appraise these investments, we have said, hey, go ahead and invest in Ethiopia. These companies, however big they are, they never have enough capital. Even yourselves, you don't have enough capital. Nobody has enough capital. That is why you'll get these politicians, ladies and gentlemen, outside here. We think that they are very rich, but every other day they are fighting for more power, for more jobs, isn't it? They're stealing all over because it can never be enough. So every time you have come up with these proposals, these people will again send you to look for capital. That is why, ladies and gentlemen, the second function of this particular person here, called the finance manager, will be capital decisions here. So he'll be able to look at how do we raise funds for this investment. And majorly, he'll be able to advise on two capital sources. Do you know those sources? Yeah, which one and which one? Debt, yes, and what here? Equity. So the two, leave alone preference. Preference shares is not very, very popular here. So we have debt versus what here? Versus equity like that. So which one is preferable between the two? Huh? Equity or debt? My online students are not talking to me at all. I can't see. No, there are charts here. I'm the one who has not read these charts. Which one between the two is the very best? Do you know what financing a project through equity means? It means either we ask the current shareholders to give us more money. Chances are they'll not give you. If you ask for what we call a rights issue here, these people will not give you more money. It's very, very hard. They'll tell you they don't have. Because you see, once in this case, these shareholders have been with RCM, they know that RCM now does not even, for example, pay very good dividends. Always, the grass is always greener on the other side. You'll always be thinking highly of these companies when you are outside. But when you come in, when these guys here want more money, you'll say, hey, no, I'm not going to give you. Yeah. Or in this case here, for example, if it's not from the existing shareholders you're asking to pump in more equity, to pump in shareholders' funds, you can as well issue out new shares. So new shares means what? Your new shareholders. What does that mean? Good or bad? Dilution of ownership. Most of the existing owners, again, will be up in arms telling you, no, we don't want. You can actually be sacked as a finance manager. Yeah. Ladies and gentlemen, we shall always recommend what here as finance managers? Debt, yes, debt. For very, very many reasons. Debt will not lead to dilution of shareholding. And this debt, remember the debt holders, you're going to give them some return. What is the name of the return which is given to debt holders? It is called interest. What do you know about interest as pertains to taxes? It's not, are you sure? Interest. It is tax allowable. That is the language. It is tax allowable. You will be able to take this interest amount and knock it against the company's revenues as an allowable expenditure. What is the name of the return that we normally give to equity holders? Dividends. Can you be allowed in this case to deduct dividends in the income statement? Karibu sana. No. No. So dividends are never taxed. So here we are going to get a tax shield. We're going to be shielded in terms of what you're paying more taxes. Here, dividends are an appropriation. That is why in most cases, we shall not recommend debt. But now, Mwalimu, you are saying, recommend debt. Then can we go ahead and say the company should take 100% debt? Again, there are risks to do with debt, isn't it? Because this debt, chances are you will be not able to pay. So if you're not able to pay the debt again, ladies and gentlemen, you shall be able to enter into this zone called financial distress, yes, which is a major topic in advanced financial management. So basically, here as finance managers, we shall be talking of an optimal capital structure mix. So this could be like, for example, debt, 60%, equity what here? 40%. And this is one of the things we shall be doing in a topic called what your cost of capital or capital decisions here. Because we shall be computing what we call this. Can you kindly pronounce this? Is it WACC or WACACA? Whichever, isn't it? And do you remember how we calculate it? WACC equals weight of equity. We are going to study this. Today we are not doing anything much. So in this case here, we shall be taking weight of equity, cost of what here? Equity plus weight of debt, cost of what here? But do you remember that cost of debt has to be adjusted for tax? Yeah. So this one here must be 1 minus what here? 1 minus T like that. Don't write any notes today. We're not writing any notes today. Nothing we are writing. So this is really, really important for us. You can see cost of equity, we are not doing any tax adjustment because cost of equity is dividends. Yeah, you see, for the shareholders, they call it dividends. But for the firm, it's a cost. We're going to pay them cost of equity like that. Great. Thank you so much. So then we have capital decisions. So now we have advised these ninjas here. They have invested in good projects. These projects have been able to look for capital for them. They have been able to put up those capital projects. Nice. The next thing is that those capital projects will yield what we call profits. When they yield profits, for example, now we are in Ethiopia, new market. We have gotten profit of 100 billion. And then you are the finance manager. Will you go ahead and give this 100 billion to the shareholders and they will be very happy? Then if you do that, you'll be against the farm's growth in future. Remember, this farm in the future would want what here? Capital. Would want this money to be reinvested back. So then what does that mean, ladies and gentlemen? That as a finance manager, you must be involved in what we call the dividend decision, which is a tricky thing. This one, because I know most of you here are going to become finance managers or you are already finance managers. Dividend policy may sack you within a day. This one here. Look at circles. You go to a circle like Mwasibu Circle, tell Mwasibu Circle, this year you guys did 100 million. And then you tell these people, you know what? Now we have got very, very good projects in the future that would want you to retain 50 million, 50%. Do you think the shareholders, the members, will accept? Most of those guys believe in what we call bird in hand theory, because most of the shareholders we have, ladies and gentlemen, they always take whatever monies they have at hand to be the most important thing. Why? Because most of the shareholders, I mean, whether we like it or not, they're what here? They're poor. They would want to use this money for fees for their kids, isn't it? So for you to be able to convince them to accept a lower dividend is not an easy thing. You need to be a very, very good public speaker. You need to be a very good person in terms of presentation and convincing. So dividend policy will be one of those hard nuts to crack when you take up this kind of responsibilities. Yeah, you start this kind of a debate, and then now you see the shareholders, all of them jumping up on a table. Yeah, they don't want to listen to you. That is when the rubber meets the road for an accountant, for a finance manager. So apart from these dividend decisions, is there any other role that you guys are able to remember from your financial management that you did just last semester and you passed very well? That's why you are here, isn't it? You did this financial management last semester. What other roles do we have in this case here for this great gentleman or lady who is being called a finance manager? Those the only three that you know. Finance manager. Risk management. Risk management is key. As a finance manager, you must sit down and look at where is this organization bleeding most from? What is making this organization lose its revenues? So for example, if we are in importation, we have something called foreign exchange risk, isn't it? This is a big risk to organizations. Because you can imagine, currently a dollar is going for 130 Kenya shillings per per US dollar. We don't know what is going to be happening next year, a little noisy under there because of the politics. If it goes to 160 Kenya shillings per dollar, meaning that the Kenya shilling has weakened. So when it weakens like that, the cost of importation becomes very, very high. Very, very high. Most organizations close up because of this. But now as a finance manager, you should be able to foresee, hey, we have got this risk. How do we mitigate against this risk here? So we're going to study with yourselves in this case here, very, very good systems. Once you foresee a risk like this, you can go to James Mwangi, a bank, and tell this bank, hey, please sell to me what we call a forward contract. Because I can see how variable this particular exchange rate is. So sell to me a forward contract. So under a forward contract, we shall be able to agree with the bank that when I will be buying this particular item in 2 months' time, I would want my rate to be locked at 140 Kenya shillings per per US dollar. When that 2 months in this case here comes, we go back to James Mwangi. Of course, we have a contract with James Mwangi. So we tell James Mwangi, want to buy this thing now. So at that time, assuming, again, you know, exchange rate, you cannot predict with certainty. Assuming that time, the dollar is going for 120 Kenya shillings. and you had agreed on a contract of 140, what do you think will happen? We must work with the contract, isn't it? Yeah, there's also a downside to do with that. We will be able, ladies and gentlemen, to look at so many ways as finance managers of mitigating against these kind of risks here. And we have got many risks. If, for example, you're a finance manager in a hotel, one of the delicacies that these hotels sell is what we call chips. Yeah, French fries. So outside, ladies and gentlemen, a packet of chips goes for how much? What? 150, 120, eh? Yeah, 120. For the longest time ever, most of this, like if you go to Sanford here, I want to believe you'll be able to get a packet of chips for 100 and what here? 20 Kenya shillings. And is it easy for you to increase this price as a hotel? No. But what do you know about the ingredients? Waru, viazi. Price yake ina fluctuate a lot. It varies a lot. At times you can get, like when it rains a little bit, a bag of a bag of potatoes going for even 5,000 Kenya shillings. And at times it becomes very cheap, even 2,000. So then as a finance manager of a hotel, this is a risk that you need to mitigate against. Otherwise, your hotel will get itself, in this case here, not being able to make a profit at this price. So one of the ways that you could use is to walk to, because you are device management, you walk to which county is known for potatoes, Muranga. So get a farmer in Muranga who has like 100 acres of of land. So he does all this, of course, assuming you've got many branches of this hotel or restaurants. So you agree with this gentleman. Tell this gentleman, you go ahead and plant potatoes here. During harvesting, I will be able to come and buy these potatoes from you at what? At a locked-in price. At a price of, say, 3,000 Kenya what here? Kenya shillings. That's a forward contract. So during harvesting, I will be able to go there and get these potatoes from him at 3,000, regardless of how much other farmers are selling their potatoes at. But again, we have what we call options. What is an option? This is a word, an English word. What's an option? Alternatives, isn't it? Yeah, you will be given alternatives. Yeah, you'll be given alternatives and the options. You'll be having alternatives. So for us in financial management, an option is a financial instrument which gives the holder the right, but not what? An obligation. The right, but not an obligation to buy or sell specific products here. Of course, with specific quantities. So the option gives you the right, but not you're not obligated. There is nothing contractually here. There is nothing that is mandatory. So if, for example, I enter with this gentleman of 100 acres, this farmer, into an optional arrangement to buy his potatoes at 3,000 Kenya shillings, then I will have the right, but not what here? An obligation. What does that mean? During harvesting, if it's an option, I'll have options. During harvesting, then I'll be able to go back to this farmer. But even before I go to his farm, I'll be able to scout around. If I get other farmers, for example, who are selling these potatoes at 1,000, I go for 1,000. That is what we call options. Options. So under options, ladies and gentlemen, there is nothing that is mandatory. It's a very good way of managing this risk here. If I get a cheaper farmer, I run away. But now this person knows that there is what we call running away. This person knows that if it's an option, you will be able to run away. So then you'll be able to ask for some premium upfront. So that when you run away, you'll be having something to hold on to. So those premiums are very important. Just like, for example, a young man who wants to get married. Yeah, you know there will be options. So if you don't marry option A, can she take you to court? She'll be crazy, isn't it? Yeah, as much as it is sad, she cannot take you to court because that is what you have the right, but you're not what here obligated. Obligated, yes. The right, but not obligated. So risk management, I love that. Now, ladies and gentlemen, this is our first class. I would want to send all of you our notes that we shall be using in this class. So do we have a WhatsApp group? Do we have a WhatsApp group now? Have you added the new ninjas who have come in? Have you added the new ninjas who have come in? I would want to attach for the online guys. It's very easy for me to share the notes with them. It's very, very easy for me to share the notes with them. And I'm going to start with the topic number 5. Karibu sana. Topic number 5. I'll start with topic number 5 because I know I normally teach up to 500 students, one class 6 p.m. When I look around, like the evening class online, we have 200. Physical now we have about 10. These are the number that I teach. The next 1 week, there'll be over 500. So as I wait for them, allow me to do the easiest topic. Easiest topic, which is chapter number 5. Chapter number 5. Rachel wants me to add her. I'll tell you the easiest way, Rachel, of being added to the group. Yeah. Please call this number. When you call or text them, they'll be able to give you the procedure of adding you up. So I'm going to do topic number 5, which is what here? Financial distress. Financial distress, restructuring. Don't write. I'll be able to give you what to write. Control save. This is great. Great. Na hii pepo usumbua wanafunzi wengi sana. Wanafunzi wengi wanaanguka AFM sana. Kwa nini? Kwa nini? And you're the easiest paper. Mulifanya namna gani la semester mkapita AMA karibu nyote? Mulifanya nini la semester mkapita AMA karibu nyote? Mulikuwa wengi sana la semester management accounting. Na mulipita karibu nyote. Mulifanyaje? The same efforts are the ones that I would want to see you guys putting in. We were coming here on Sundays, isn't it? Yeah. Yeah. So I expect this time around here, you guys should be able to start volunteering very, very early for these Sunday extra classes. Yeah. You don't have to come here. Like the Sunday class, you can study from home. That's what you used to do, isn't it? Yeah. Sunday class, you can say all of you study from home, but I always teach them from here. So if you come, you'll be able to give me company. Like Marion gave me company throughout the semester, isn't it? I should be able to give you a present for that, right? We shall agree. Is it 6 p.m.? I can't remember. Sunday or 4 p.m. to 6 p.m. We'll agree. We'll agree. The more the sessions, the better for you. Because the weekend classes, we use them to do past paper questions. The more the classes, the better for you. And I'm very, very flexible because if you tell me, Mwalimu, on Sunday, we normally go to church, wake up at 5 a.m. to 7, and then I will leave everybody to go to church, the better. But we shall agree. This week, there is nothing like a discussing about additional classes. I don't want to be the bad teacher. Yeah, we shall agree later on, right? We shall agree. So the notes I'll send, you guys will need to print them and ensure that you have them. I don't change them often. So printing them will be very good. Marion, do I have your email address? Ah, really? Marion. No, I don't have it. Yes, it's marion.marion5891. Great. So that is AFM. AFM document. All right. For the online ninjas, so I've sent it on your email. Please try to retrieve it and give these other ninjas. I normally call my students ninjas because we are coming to fight Kasneb, isn't it? We're on the same side, right? We are on the same side. You will love this subject a lot. The best subject in CPA, one term. One term is our slogan here. FM. Then go straight away to topic number 5. Have they given you access to the Wi-Fi? So somebody is asking whether I have just begun this AFM, whether it's in the right class. Uh, for the evening students, the online students, your classes normally run from 8 p.m. to 10 p.m. That is Friday, Saturday, and Sunday. So basically, these 6 p.m. classes will be for you guys now. It will be revision. It is very, very important you attend. FM special revision group. Don't worry. I've attached it here. You haven't seen it yet. I've attached them here. Have you sent to the group? Great. So open this and search for a topic called restructuring. 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 Please ensure that you have got access to the Wi-Fi if you are here with me. It's very important. So don't say that Mwalimu punished us in terms of bundles. No. So control find restructuring. It is chapter number 5. It's on page number 41. Page number 41, chapter number 5. Page number 41, chapter number 5. Great. Life is good. So then I'll be able to dive straight away to you, first of all, understanding. Are you guys there? Great. Restructuring and reorganization. Background, have you gotten it? Background on restructuring and reorganization. Corporate restructuring is the process of reorganizing a company's operations, ownership, or financial structure to improve profitability, efficiency, or adapt to changes in the environment. It aims to enhance shareholder value, reduce costs, and ensure business survival in the dynamic water market. Are you guys aware of any company in Kenya here that has ever done restructuring? Oh, yes, Kenya Airways. Kenya Airways, in this case here, was able to do what we call a capital restructuring. Remember, Kenya Airways had borrowed what we call a syndicated loan. Syndicated loan. Under this syndicated loan, it got a big, huge loan from 3 banks, namely ABSA, Stanchart, and then Equity. Yeah. So after they borrowed like this, of course, you and I know that Kenya Airways has not been doing very well financially. So after borrowing, again, they found themselves in a situation where they could not repay back the debt, together with what here, the principal and the interest. So they called these 3 banks to some negotiations. And then they told this bank, now we have a debt with you. Since we can't pay you back your money, accept equity instruments, accept our shares. So assuming in this case here that their debt to equity was, for example, initially 80% versus what here, for example, 20. So after restructuring, so they changed their capital structure. So changing their capital structure, now you can see, of course, given that now they accepted equity for debt, it is a debt equity swap. So it means that the debt must have gone down, perhaps to what here? 40%. And then, of course, equity increase, because the total structure must be 100%. So it means that equity must have gone up to what here? To 60%. So basically, we restructure, ladies and gentlemen, for purposes of what here? We've been told the enhancement of what here? Efficiency, to ensure that we are able to operate efficiently, profitably. Because you can imagine here, ladies and gentlemen, with this debt, when debt is so high and our business is not able to break even, it means we will be facing every other day auctioneers. There is no way we shall be efficient in our operations. So this capital restructuring is one of those particular areas, ladies and gentlemen, that you as finance managers will be able to do what here to get engaged in for purposes of ensuring that companies that are not performing very well. Like now we have the giant Mumias. Mumias currently, as we speak, is on its knees. On its knees because of what here? It's not doing very well. So then you, if you are appointed as a receiver manager, you should be able to restructure this kind of an organization into profitability. It's about negotiations. It's about, in this case, you're looking at what we call the organizational structure. Yeah, for example, organizational structure, we have what we call the board of directors, right? So under the board, then of course we shall be able to have the CEO, and then we have in this case here, not MD, but for example, somebody, director of finance, director of marketing. You know, most of these organizations that are so useless, which are making losses outside here, they have a very, very big organizational structure. You may even think like it's a military barrack. You know, in the military barrack, we'll have like colonels, lieutenant colonels, we have majors, we have captains, we have, by the time you're reaching the person who does not have any rank, we call them privates, that will be a very lengthy structure and everybody's drawing a salary. So when you are called upon to look at these companies who are making losses, you shall be forced to also restructure them in terms of what here the company's reporting structures. There are some positions which are normally redundant. They're not important to the company. We need to declare them as such, and then of course we fire them so that we can get the company becoming what here efficient. I share the document. Can somebody in this case here help me reshare this document? Because every time I'm resharing the document here, it means I close it up. So before I read lots of literature, I would want to introduce you to something very important. So before I show you quite a lot of things here, I would want us first of all to measure what we call financial distress. So if you're writing there, now mention financial distress. Now that is very important. You have to start by writing the topic. It's topic number 5. You shall not write so many things. So financial distress. And the financial distress, I would want us straight away to go to the models of measuring financial distress. And if you look at your handout, and this is a highly examinable, this is a dangerous area. Dangerous area. This is a dangerous area. So there are very good theories there which you'll be able to understand after I teach you how to, in this case here, measure whether companies are stressed financially or not. So I would want us to go straight away, please, to page number 40 to page number 45. Page number 45, you'll be able to see 5.12, models for predicting corporate failure. Corporate failure is what we call distress, eh? Yeah. Page number 45. Are you there? Page number 45. Are we there? So we have what we call quantitative models, and then we have qualitative models. So today, because it's our very first class, I'll be able to do the first model, which is called Altman's Z-score model. Yeah. So under financial distress, you should have that title down there, models for predicting corporate failure in your notes. Their notes we must write, like these ones, we must write them down. Models for predicting corporate failure. Models for predicting corporate failure. Corporate failure. Models for predicting corporate failure. And the very first one that we are looking at today is what we call the Altman's Z-score model. Altman's Z-score model. The very first one, which is given there. Yeah, and we have a summary there. You can see Altman's Z-score model combines 5 financial ratios to measure insolvency risk. It combines 5 financial ratios to measure insolvency risk. Without reading so much, I always like describing these things using a past paper question. So if you scroll down there, you'll be able to see April 2024, question number 4C. If you scroll down there, you'll be able to see April 2024, April 2024, question number 5C. So we write it down. April 2024, question number 5 cow. April 2024, question number 5 cow. This one, yeah, question number 4. Where did I get 5 from? Thank you so much. Question number 4, yes. All right. So we are told here the following are the financial statements of Bobby Limited for the year ending December 23. So you can see Bobby Limited so nicely arranged there. And then you can see there, down there, they want us to give them, they've given us the Z score is to be calculated using the following formula, Z score. They are even giving us formulas. So number 1, they want us to give them the Z score of Bobby Limited for the year ending 31st December 2023. How many marks? 6 marks. Shall we be able to get all those marks? Yes. Yes. So please look at the balance sheet. I want you to give me 2 things under that balance sheet. I want you to give me the total assets and the total liabilities from the balance sheet given. If you don't get the total assets and the total liabilities given there, I'll be able to call your employers tomorrow. I tell them we have fake accountants tomorrow. Uh-huh. Uh-huh. Are we going to fire somebody? Are we going to fire somebody? They are not talking to me. So according to the online ninjas, from the balance sheet, they are saying that the total assets are how much? Let me start with the online ninjas. Total assets, you see total assets are current assets and non-current assets. The online ninjas, they are saying Mwalimu total assets are very easy to get. Total assets are very easy to get. How much are they getting? 200 what year? That is given, 256,800, isn't it? Because if you're measuring bankruptcy of a company, we must look at the total assets vis-a-vis what year? Total, that should be the first thing. Total assets vis-a-vis total liability. So they are telling me the total assets is 256,800, isn't it? How about total liabilities? Online ninjas, they're not talking here. Total liabilities, look at your balance sheet. Oh, the students who haven't yet gotten this document and the ninjas who don't want to share. So total liabilities go to the financed by. So financed by, what am I able to see? I'm able to see current liabilities of 72,000 here. Are you able to see that current liabilities of 72,000? I'm alone. Current liabilities, you can see trade payables and notes payable, totaling to 72,000, isn't it? How about non-current liabilities? 184,800, isn't it? Are you sure? It is 120, isn't it? because non-current liabilities, we have mortgages, 20 years, 8% debentures, 72. So in this case here, 120,000. So meaning that our total liabilities will be 120,000. What here, somebody? 72,000. Giving me how much here, somebody? Now, initially, we had it very, very easy. We had this one very, very, very easy. Now there is a change. Every time CASNEP changes things, and unfortunately, they call us as teachers for those kind of what year changes. You see, for so long, we've been saying that preference share. No, what do you know about preference share capital? What do you know about preference share capital? Preference share capital can either be an equity instrument or a debt instrument. When, for example, equity preference share capital are redeemable, if they are redeemable, it means it's a form of a debt instrument. Redeemable because you fund debt instrument. So if you go to a question and then you see they are telling you that preference share capital is redeemable, please add that figure here. Because redeemable preference share capital is a debt. Please write somewhere there. Preference. Write like this. Redeemable. Redeemable. Write like that. Redeemable preference share capital. Redeemable preference share capital equals what here, somebody? Equals it's a form of debt. It's a form of what here, liability? Liability, because you see, debts are normally refundable. So if they are redeemable, we shall include them in the total liabilities. Right there's a note that if preference share capital is redeemable, include it in the total liabilities. Include it in the total liabilities. If it's redeemable. If it is redeemable, we shall include it in the total liabilities. How about if it is irredeemable? Remember how we define equity. Equity is a permanent source of what here? Capital. Equity, permanent source of capital. You see, when you buy shares of Safaricom today, you have given them your money permanently. If you want to leave Safaricom and you have their shares, what do? You sell in the secondary market, isn't it? So you see them, they'll be having that share capital permanently, yes. So if, for example, you're told that preference shares are irredeemable, write again somewhere there. Irredeemable preference shares, irredeemable preference shares equals what here, somebody? Equals equity. Equals equity. Irredeemable preference shares equals equity. Equals equity. And if they are irredeemable, they shall never be included under total liabilities. You're writing there again as a note. This could be a second note that if you're dealing with irredeemable shares, do not include them in total liabilities. Do not include them in total liabilities. Have you written that? I doubt. Let me read this again. Let me read this again. Let me read this again. So I can type for you very fast, online ninjas. So what you're saying here is that if we are dealing with irredeemable preference shares, we don't include them in total liabilities, since irredeemable preference shares are equity instruments. They are a permanent source of capital. So I've been able to type for you very fast there. Are you able to see? Are you able to see? Are you able to see in the notes? You can now pick that. If you're an online student, you pick whatever I've written there. It's in very good grammar. And then you paste it somewhere in Word document. Word document. So if it's irredeemable, shares, you have said they are equity what here? Instruments. So I would want you to look at the preference share capital that we have, and then you advise me. Look at the equity not equity, but the preference share capital that we have in the question. Look at them keenly. Look at them keenly, and then get to advise me. Am I supposed to take them as a form of liability and add here? Huh? We are supposed to add as a liability. The sister, I like sisters in this case here, and the brothers in this case here who are active. You just give me your answer without fearing anything, because accountants are not supposed to fear anything. That is the correct answer. You see, it's falling under equity. It's falling under equity. What did the online students say? The online students said nothing, 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 absolutely nothing. You should have written it there, we shall overcome, isn't it? But have we understood now? If you look at the preference shares, oh, no document, I need to share this document, honestly. You see, initially, remember, if I've been teaching you around here, you know that we have always been adding reference share capital without thinking. But now they have brought in a new model. Fortunately, they call all of us as financial management teachers or examiners, and then they tell us, hey, now we are going to adopt this model. Allow me to share this document, just one. No one shared because I have not done it, but I should be able to have very good students who are able to share this with other students. Actually, the very best is for you to share this on WhatsApp, isn't it? You simply pick it and share it on WhatsApp in the paid groups, we have said so many things. What have we said about this preference share capital? How have you understood this preference share capital? If it is redeemable, add it under liability, because redeemable means you shall return. It's a liability. If it is irredeemable, it's permanent source of capital, that is equity. If I go to the statement of financial position and then I get it under equity, know that that's an equity instrument. If it is an equity instrument, if it is redeemable in the balance sheet, it will be given under non-current liability. If you see it in an non-current liability, then you add it. It's part of a liability. It's part of this liability. It's part of this liability. All right, ladies and gentlemen, we are doing very well. We are doing very well. Now, next thing, ladies and gentlemen, when you see any question to do with the Altman's Z-score, Altman's Z-score, you shall always be forced to remember some acronym. We normally use acronyms in AFM. So we have acronyms. So the acronym we shall be using under Altman Z-score model is what we call the famous what year? WRMS. Okay, on to Altman's question. Always remember this acronym. Is it a very hard acronym to remember? No, it's very easy. If I'm able to remember it at my age, it's very easy. So I'll be able to remember it very fast. So then we normally divide this into 5 because remember we said somewhere that Altman's, we normally have how many ratios? 5 ratios. So this one here will be the first ratio X1, X2, X3. This is X4. That there is what here is X5. You must write this acronym and then you must circle it. Yeah, freehand. I know there are girls around who like having things neat. They would want even to circle this using the 5 shillings coins. No. The circle, freehand. So that acronym is really, really important. It's really, really important. This acronym is really, really, really important. So Altman's Z-score, WRMS. Now let's write this WRMS nicely downwards. I want to show you something here. I want to write this WRMS. So in this case here, we have said that X1 is WO, isn't it? X2 is R. X3 is what here? E. X4 is M. Then we have S, or rather X5. X5, which is S. So please, we'll be able to write just beside this that this WO stands for working capital. The WO here stands for working capital. I hope I can now rub this right. Now we're writing this right. Yeah, I should be able to rub this. So WO stands for working capital. Working capital. This R stands for retained earnings. Retained earnings. This E stands for EBIT. This stands for market value of shares. Market value of shares. This S stands for sales. Please write like that. And once you finish, give me a thumbs up, especially the online guys. Great. So Kelvin, I'm so sure you'll be able to do me that favor now of sharing the document in the WhatsApp group, Kelvin. And any student who is around here who has not yet paid us fees, who would want to become part of the Ninja Fraternity, RCM. Yeah, you simply give us a call there. 0793 555, I'm right here. 0793 555 000, like that. Now, for those of you who have ever gotten children, if you're a father or a mother, these kids when they are born, yeah, very young, very beautiful, great people, young people. All right. When it comes to them speaking, what is the very, very first word, the short word they will always pronounce? All of them globally. Globally. Baba, mom, you are very wrong. You guys don't have kids here. It is tata, tata. So you say everything here, you divide everything by tata, tata, ta, ta, except this one here you say TL, and then you come back to ta. Let me see what the online guy said. The very first. Ugali. Dennis, ulipata mtoto aina gani? Dennis, you're not a father. Ugali, no. That's very complicated. It's either baba or tata. So the lady will take care of these kids. When it comes to them appreciating people, they appreciate their fathers. Yeah, like the one saying dada. Dada, I agree. Dada, Linda, you must be having somebody. Goreti, baba, yeah, yeah. Mwingine amesema mama, Milton. No, no, no. But there we are. So this TAR stands for total assets. TAR stands for total assets. TAR stands for total assets, which fortunately all of us have. We have this total. Do you remember that figure? Was it 258 something? We have these total assets, honestly. To 800, isn't it? And then this TL stands for what here? Total liabilities, which you guys had given me as 192,000. Thank you so much. 192,000, like that. Yeah. These finance managers, I want to catch them. I want to catch them. Is there anybody who would be knowing the formula of getting working capital? Let me hear from you. How do we get working capital? Yes, sir. No. Current assets minus current liabilities. Thank you so much. Current assets minus current liabilities. Thank you so much. It's CAR minus CL. Current assets minus current liabilities. The one you're speaking about is called net assets. Net assets, yeah. So anytime they want us to get working capital, like now here in X1, we are taking, in this case here, current assets minus current liabilities. Are you able to see the current assets from your balance sheet? Go to the balance sheet. Myself, I can't see it because I don't have it. Or rather, I would want it to come from you. Current assets. Look at your balance sheet. Statement of financial for 800. 88,800. Like that. Even the online guys, yes, they are able to see it. Let me just share my screen with these online guys. All right. So when you look at assets, ladies and gentlemen, I think I shared the wrong document. Ah, great. Life is good. Life is very good. Very good. Ah, I know why I'm sharing the wrong document. It's because I had to bring mine down for purposes of sharing. And unfortunately, when I do like that, I have to keep on saying find. Yeah, page number 45. That's why, Kevin, you'll be my buddy. You will be sharing this with your friends. You will be my greatest buddy. Great. Good. Great. So when I share my screen like this, ladies and gentlemen, when I share my screen like this, when we go to the balance sheet, yeah, they're right, but that's good for me to share this. They are very right. So when I go to my balance sheet, what am I able to see here? So when I go to my balance sheet, leave alone the statement of comprehensive incomes. Yeah, I can see my current assets divided into three: inventory, trade receivables, and bank balance. Yeah, the three of them adding to 88,800, isn't it? Go to the liability section. Please read for me the current liabilities. Down, down, down. 72,000, isn't it? 72,000. 72,000. So then are you able to give me the working capital? 16,800, isn't it? So this is 16,800. This is 16,800. So up to here, especially the online ninjas, because I can't get feedback from you easily. Are we really together, the online ninjas? If you're able to follow, put your thumbs up like this. Yeah, always try to use emojis. Online guys, try to use emojis. When you are happy, for example, you've got two faces there, two faces. When you are happy, you can use this emoji. If you're not able to understand nothing since you began the session, pick this one here. I'll be able to know that there is a problem somewhere, right? Yeah, they're okay. They are happy. They're happy. Thank you so much. So then go ahead and give me this X1. So X1 then will be the working capital that we have here, 16,800. We divide this by total assets, which are 256,800. So please give me 4 decimal places now. 4 decimal places. Give me 4 decimal places. Quotient there. 4 decimal places. Thank you so much, Franco Olango. Olango has been very supportive to RCM. 0. 0.0654. Thank you so much. Now, I would want us to look for X2. X2, you can see it's very easy. They want us to pick retained earnings divided by total assets. Remember retained earnings, your examiner would want to confuse you. They'll give you retained earnings under the income statement. That is retained earnings for only 1 year. As you want cumulative retained earnings, so retained earnings, you shall always speak here, are retained earnings given in the statement of financial position under equity. Under equity, you can even write somewhere there, or even if you call it balance sheet, for us, we don't care really much in AFM. Yeah, so retained earnings, are they able to see retained earnings, these young ninjas? How much do we have there? 16,800. So we have here 16,800 coincidentally divided by 256,800. Because you see, it is retained earnings divided by total assets. So which of course will give me the same answer? Or is there somebody who would want to prove that it's the same answer? It's the same answer because the figures are the same. The same. So let me remain quiet a little bit and see how you'll be able to compute X3. Let me see how you'll be able to compute X3. How do we get to compute X3? How do we get to compute X3? Pius, today I'm not seeing you talking a lot, or these are different Pius. There is a Pius I normally have who talks quite a lot. Remember this subject, we shall be able to talk candidly without fearing anything. There is nobody who fears this man here. Nobody. Nobody. I'm a very friendly teacher. And if you're very, very keen, you'll end up getting a lot of money from me. Did I give you a lot of money when you're doing MA? Yes, you'll end up getting your fees back. Yes, 4,000 EBIT. You see, EBIT is the same as earnings before interest and tax, also known as operating income, operating profit. Or you are on the road, then I understand. So are you able to see operating profit? Ah, is it 15,000? They're not talking to 50,000, right? 15,000. So we are looking at the income statement now, isn't it? So after operating expenses, we have operating what here? Profit. You see, operating profit is the profit before we charge interest and tax. Yeah. Operating profit is the same as EBIT or PBIT. PBIT. Very important. So this will be 15,000. We divide this by, again, TAR. TAR is the total assets, 256, 8 and 0, which will end up giving us how much? You can't be taught like this and then you fail, not unless you have a problem. Yeah. If I teach you like this and you're very, very consistent in my classes, like I told you in advanced MA last semester, but I saw some of you, of course, that's also understandable, out of 500. If I have like 20 failing, that's okay. Is it called normal loss? Very bad term, but it is. It's life, yeah. So, and I know the mistake they make. Like I gave you mocks last semester for MA. Those mocks, they come in handy for your final exams. Final exams, my mocks cannot be very, very far away from exams. Normally, they're very, very close. So if I give you a mock, and when I give you a mock, you run away, you can even be knocked by a vehicle outside here, running away from an exam. It's very, very sad. We shall do all our mocks. Yeah, we shall participate in class, and then we'll be able to pass this thing one term. One term. All right. So you guys haven't yet given me the number here. So this is 0.584. Thank you so much. So then we come to X4. X4, they want me to give them market value of shares. This I have to do it as a separate working. Market value of shares. Market value of shares. Thank you so much. One term it is, Masi, I can guarantee you. One term it is. One term it is. One term it is. So now we are getting market value of shares. Market value of shares. This is very easy to get because I will take NOS times market price per share. I will take NOS. NOS stands for number of shares. So in the question, have they given me the NOS? Yeah, if you go to the balance sheet, you'll be able to see shares. How many are they? Are they 21,000 or something? Huh? How many shares do we have there? 500,000 shares. 500,000 shares. Great. So there are 500,000 shares, isn't it? So we have here, so it will be market value of shares will be 500,000. And down there in the additional notes, they have told you how much each share is worth in the market. What is the market price per share? 42, isn't it? 44. Are we reading different? You know, there is a difference between book value and market value. So you can see in the book value in the balance sheet, it's 24, isn't it? But you know, that could be like the par value. Look at the market value down there. Are you able to see market value has been given? 42, right? Yeah, note number 2, the current market value is 42. Great. Thank you so much. Thank you so much. So times 42. So are you able to see a figure there? 500,000 times 42? 21 million, isn't it? Which will be the same as 21,000, because our other figures, if you look at your balance sheet, whenever you're doing figures outside the balance sheet, always be careful. Our balance sheet figures are in shillings thousands. Shillings thousands. So you shall also capture this number in terms of thousands. So it shall be read as 21 what here? 21,000, yes. So now it can fit here. So market value of shares is 21,000. Market value of shares is 21,000. Is 21,000. We divide this by total liabilities, which are how much? 170? 192,000, yes. 192,000, yes. 21,000 divided by 192,000, which then will end up giving us 0 point something. 0 0.1, 0.0194, eh? Thank you so much. So then we go to X5. X5 is the sales figure from the income statement divided by total assets. X5 is normally the easiest. X5, we are taking total sales, which is also the same as total revenue. Total revenue. Is there somebody who is able to see the total sales here? Anybody who is able to see the total sales? 16,000, right? 16,000. We divided 60,000, right? So 60,000, divide this by the total assets, which are worth how much? 256,800, which then will end up giving us 0 0.236, eh? But I want 4 decimal places. 23 or 33 in between. So the online ninjas are also getting the same. Thank you so much. Now, but you have to be very, very careful. Mwalimu has given you a formula for Waremas for getting this Altman's thing, isn't it? But you see, at times the examiner can choose to give you his own formulas. So if the examiner gives you his own formulas, will you use the examiner's formulas or Mwalimu's formulas? Who is Mwalimu to examiner? It shall be examiners. The examiner's formulas will prevail. Please look at the formulas given by the examiner and see whether they are similar to ours. Are you sure they're similar? Because at times he interchanges. Look at the formulas given down there. Like the first one, X1 is working capital over, that's very good. X2 is retained earnings, very good. X3 is EBIT over, very good. Market value of equity over book value of debt, which is the same as what your total liabilities. X5 the same. We are lucky. And now you see, after you get these 5 ratios, you are supposed to substitute them in the Z equation. And the Z equation shall never be crammed by anybody. The Z equation shall always be given to you in an exam. Are you able to see the Z given there in note number 1? The Z equation shall always be given. If they bring a question without Z equation, please don't even attempt it, because we shall take it as an erroneous question. The Z score equation shall always be given. Z score equation shall always be given. That one shall always be given. That one shall always be provided. These ones shall always be provided. So then our Z, ladies and gentlemen, I can see our Z there is 1.2x1 plus 1.4. You can even see myself, I've never crammed it. I will never cram it. I don't want to cram it. Plus 3.3x3, 3.3x3 plus 0.6x4 plus 1x5, or just x5, like that. So this equation is given here. So then can you kindly do me a favor? We now have every other thing that is needed. Yours is to come and substitute. So we are saying that our Z will be 1.2 times X1, which is 0.0654 plus. So plus, what else do we have here? Plus 1.4 X2. X2, ladies and gentlemen, which will be what here? 0.058, plus we have here 3.3 times x3. X3 is here, 0.1094 plus I've omitted x2, eh? So it's supposed to be so x1, x2, x3, x4, x5. So we have here 1.2 times this plus 1.4 times x2. What is the value of x2? 0.0? 0.0654, like that. Thank you so much. Plus 3.3. So are you able to read for me the x3 figure? It is 0.0584 now. 0.0584 plus 0.6 times x4. X4, which is what here? 0.1094, isn't it? 0.1094 plus 1x5. So x5 is 0.2336. So is there somebody who is able to give me this Z value? $1.30. Let me see what other students are getting. There is a Samsung guy getting 0. Naomi gets 0.662. You guys be serious. We need to get the correct 662. Take your calculator. Part there 1.2 times this. Don't miss out anything. Plus 1.4 times this. Plus 3.3 times this. Plus that times that. Plus that times that. Give me the final answer. 0.66. 2, eh? 0.66. Let me hear from the other students, because like online I have so many of them. Physical, I would want to hear from the boys. All has confirmed 0.662. The boys, are they getting this 0.662? Great. Great. Now from there, ladies and gentlemen, we shall be able to go to the number line. We'll be able to go to the number line. So now we have the number line. Now this is really good. So now we have the number line. The number line. The number line. The Altman's decision number line. Very important. So it is 1.8 here. It is 3 there. You get some books saying 2.7, but they have been able to squeeze it to 3. This number line. So then this number line is so important to us, ladies and gentlemen, that if you compute your Z score and get your Z score being less than 1.8, this one here, it means that your company is 100% bankrupt. 1.8 and 3, decision, want to make a decision now. So if you compute your Z score, then you get your Z score being less than 1.8, automatically that means that the company is what year? Bankrupt. Why is this 0.662? It is less than 1.8, isn't it? So this is less than 1.8, and therefore the name of the company. Do you remember the name of this company? What is the name of the company? Wabi. Bobby. So therefore Bobby is bankrupt. It's bankrupt. There's nothing that can be done. This one here go and sell their assets, realize their assets, and pay whoever you want to pay in accordance to that category. So this is very bankrupt like that. Now, ladies and gentlemen, after you do that, if, for example, it is in between here, 1.8 and 3, it's 50-50. So if you get your company's Z score being here, it means that this is 50% bankrupt. And then now more than 3 is 0% bankrupt. 0% bankrupt. More than 3, it means that it is 0% bankrupt. Basically, that means that the company is what here? A success. The company is successful. So from 100% to 50, 0%. Yes, I pardon. I'll be able to pardon. Yes. And as I repeat this, let me see from this 1.8 and 3, what if in this case here we have a company called A whose Z score is 3.3 according to the number line? It is 0% bankrupt. This is a successful company. Like Safaricom, if today tried computing its Z score is really high. It's very, very successful. How about this company B? So company B, Z is 0.9. It's 100% bankrupt, meaning that this company is a useless company. It's bankrupt, isn't it? We look at the last one, C. So C, you get a Z score of 2.3. Yeah, 50% bankrupt. That's how you interpret. So Tina, please listen to me very well. Whenever you come to interpretations of the Altman's values you get, you shall always remember the 1.8 and 3 rule. So we have here 1.8 and 3 rule. Then remember, this is 100% bankrupt. Yeah, this is success zone. And this is a gray area, 50-50 gray area. So if the Z score you calculate like the one you have calculated here, which is 0.0662, you see that is here in the bankruptcy region. So it means that our company is bankrupt. If the Z score we calculate, like now 2.3, falls in between here, then this is a gray area. It could either go either way. It could go either way, either bankrupt or succeed. So you simply talk of what you're 50% bankrupt. Someone will be able to understand it's 50% bankrupt and 50% what is success. So I hope that is okay, given that this is our very first class. But before I go, please tomorrow, even today, if you get hold of your companies, your own companies, statement of financial position, and your own company's income statement, please try as a homework to compute what year the Z score for your own company. What values do you think will you get? Guesswork. Is your company very successful from what you are able to assess or bankrupt? But it's not good to guess, because you have the numbers, you're the accountants. Let's go and do what we calculate our Z score. So the question is, if you get Z score telling you that your company is bankrupt, what do? You can't resign, but you start looking for greener pastures. You shall never resign. Accountants do not resign. Sawa sawa. So asante, mmeshani add kwa WhatsApp group yenu. Mario umeniadd, umetuma link. Thank you so much. I hope you've enjoyed the session. My personal number is 0721 620 183. And you only call me when you are giving me money, isn't it? You only call me when you're giving me money. Yeah, they call me the CPA Chief Ninja. CPA Chief Ninja. Yeah. So, yeah, great. So, and of course, the online students, these 6 p.m. classes are mandatory for you. Mandatory because you're coming to revise. They're mandatory. And I'll make sure that I do different questions from the questions that I normally do in your classes for you to come and get more exposure. So it's important you get to attend. And if you miss, always, even you guys, whenever you miss a class, we will be able to open for you what we call a learning management system. So this LMS, we normally put all videos and notes. So whenever you miss a class, go to this LMS and watch the video immediately. And before you leave here, we are opening this LMS, right? Thank you so much. Bye-bye. See, when is the next class? Is it tomorrow or Wednesday? No, Wednesday I'm not available. It's either We pick it on Thursday or when? Or Thursday is very good. AFR. I'll change with Mr. Kyoko. I'll change with Mr. Kyoko because Wednesday is AMA. And the AMA, we have already over 300 students who have paid for the online. Are you doing advanced MA? Then Wednesday is AMA. I'll be able to change the timetable and then I will. So the next class will be on Thursday. The AFM next class, 6 p.m. Thursday, 6 p.m. 6 p.m. on Thursday. Please don't go without getting access to the LMS. So you don't come on Wednesday. Why are you avoiding AMA? We shall change the timetable a little bit, don't worry. Because if you did management accounting last semester, you should do AMA this semester. That's how it goes. Don't be cheated by anybody. If you did audit and assurance last semester, do advanced audit, you finish. No, you force us to change the timetable. Force us to change the timetable. If you did you see like now a topic called variances. It is exactly the same variance you did in. You'll get an easy time. Easy time. That's why you guys need a lot of guidance, but we shall overcome. Thank you so much. Bye-bye. See you on Thursday. Yes, yes, yes. In the group, yes. That group is very important. Also add Mr. Kyoko there, right? Yes.